Your stops are too far. Your position sizes are too big. Your risk is too high. And this is exactly why accounts blow up. I am watching traders every single day. And the number one pattern I see isn't bad entries or missed exits. It's accounts vaporizing because risk management is completely backwards. You walk into a trade thinking this is the one, and you risk 5% of your account on a single setup. You place your stop 200 pips away because you're afraid of getting stopped out. And then you panic when the market moves against you. Here's the reality. Professional traders aren't smarter than you. They're not seeing something magical that you're missing. They're simply protecting themselves first and profiting second. In this video, I'm showing you the exact framework that separates profitable traders from account killers. We're talking position sizing, risk calculations, and how to build a trading account that survives multiple losses and captures profits consistently. Let's start with the foundation, the 1% risk rule. Here's what it means. On any single trade, you never risk more than 1% of your total account balance. That's it. That's the rule. If your account is $10,000, you risk $100 maximum on one trade. If it's $50,000, you risk $500. If it's $100,000, you risk $1,000. Simple math. Now, why 1%? Because it creates something called ruin protection. Let's say you hit a 10-trade losing streak, which happens to everyone, even professionals. At 1% risk, you've lost 10% of your account. You're down, but you're not decimated. You have capital to trade. You have psychological resilience. But what if you risk 5% per trade and hit that same 10-trade streak? You've lost 50% of your account. You're panicking. You're making emotional decisions. You're revenge trading. You're done. The 1% rule isn't about being conservative. It's about surviving long enough to see your edge compound over 100, 200, 500 trades. Most traders fail because they blow up on trade 47 before their edge ever has a chance to work. Risk management prevents that. Now let's get specific about position sizing. This is where the math becomes your protection. Here's the formula you're using from now on. Position size equals account balance times risk percent divided by distance to stop in pips times pip value. Let me make this concrete. Your account, $10,000. You risk 1%. So your risk amount is $100. You see a setup on ES, E-mini S, and P500. Entry at 5,000. Your stop is at 4,990. That's 10 points. Each point on ES is worth $50. So your stop loss distance is 10 times $50 equals $500. Wait, your risk amount is $100, but your stop is $500 away? That doesn't work. Here's what you do. You reduce position size until the math works. Instead of buying one contract, you buy 0.2 contracts. Now your risk is $100. Perfect. This is the key insight. Your position size bends to match your risk, not the other way around. Most traders do this backwards. They decide, I want to buy one ES contract, and then they place their stop wherever it feels right. Then they're risking way more than 1%. No, risk first. Position size follows, always. Stop placement isn't arbitrary. It's based on the setup itself. For support and resistance setups, which you learned in video 4, your stop goes just below the support level you're bouncing off. Not 50 pips below, not 100 pips below, just below. For trend continuation setups, your stop might go below the recent swing low. For breakout setups, your stop goes just outside the breakout zone. The key, your stop is based on where the setup is invalidated, not on some random comfortable distance. Once your stop is placed logically, Then you look at your profit target. This is where risk/reward comes in. Professional traders target at least 2-to-1 risk to reward. That means for every dollar you risk, you're aiming to make $2. Why 2-to-1? Because if you're right 50% of the time, and 50% is realistic for many traders, 2-to-1 risk/reward makes you profitable. 50% winning trades times 2 profit equals 100% gains. 50% losing trades times 1 loss equals 50% losses. Net plus 50% growth. At 3-to-1 risk/reward, you can be right just 40% of the time and still be profitable. At 1-to-1 risk reward, you need to be right 51% plus of the time to make money, and that's cutting it dangerously close. So every trade you take, calculate your risk. Calculate your profit target. Make sure the reward is at least double the risk. If it's not, don't take the trade. Here's your complete risk management checklist. 1. Calculate your 1% risk amount based on current account balance. 2. Identify your setup and place your stop based on setup logic. 3. Calculate how many contracts/shares you can trade to hit that 1% risk. 4. Identify your profit target. 5. Calculate your risk/reward ratio. 6. If it's at least 2-to-1, take the trade. If not, skip it and wait for the next setup. This is what separates professionals from everyone else. It's boring. It's mechanical. It's not intuitive, but it works. You're not trying to make the biggest trade possible. You're trying to survive and compound over 500 trades. Risk management makes that possible. The truth is, risk management is the boring part of trading. It's not exciting. It won't make you rich on a single trade, but it will keep you in the game long enough for your edge to work. Video 8 teaches you what happens after you enter live trade management, how to adjust, when to take profits, when to cut losses. That's the other half of the equation. If you need specific Claude prompts for this video, look at the pinned comments. I wish you all the best in your trading journey. And if you are an advanced trader, keep looking for new updates at OrisTrade.com.